Guten Abend, liebe Zuschauerinnen und Zuschauer. Ich wünsche Ihnen einen schönen Donnerstagabend und heiße Sie herzlich willkommen zum Online-Seminar von der CME Group und Finanzen.ch. Mein Name ist Irina Musaschwili und ich bin Ihre Moderatorin in der kommenden Stunde. Das Jahr 2024 war geprägt von bemerkenswerten Entwicklungen. Boomende Märkte, historische Höchststände bei Kryptowährungen und eine Neuausrichtung der Zinspolitik durch die US-Notenbank. Doch wie werden sich diese Trends im Jahr 2025 fortsetzen? Angesichts bevorstehender globaler wirtschaftlicher und politischer Veränderungen stehen Investoren vor entscheidenden Fragen. Welche Strategien sind jetzt sinnvoll und wie können Sie von den Chancen profitieren? Antworten und praxisnahe Einblicke erhalten Sie im heutigen Online-Seminar. Ich freue mich, dass Sie alle heute mit dabei sind, sich bereits so zahlreich eingewählt haben. Und genauso sehr freue ich mich, unseren heutigen Gast in dieser Runde begrüßen zu dürfen. Good evening and a warm welcome to you, Tarek Dennison. It's great to have you with us today.
Thank you, Irina. Very good to be here as well.
Thank you so much. Unser Gast wird sich gleich zu Beginn seiner Präsentation noch ausführlich vorstellen. Bevor wir in seinen Vortrag einsteigen, möchte ich Sie, liebe Zuschauer, noch auf Folgendes hinweisen. Bei Fragen oder Verständnisproblemen können Sie uns während des Online-Seminars über die Chat-Funktion kontaktieren. Am Ende der Veranstaltung wollen wir in einer Fragerunde gemeinsam noch offene Fragen klären. Nun haben wir Sie, liebe Zuschauer, genug auf die Folter gespannt. Wir haben ja noch einiges auf dem Programm, dann wollen wir nun direkt loslegen. Tarek, it's your turn. You can go ahead and share your screen directly with us and start your presentation.
Wonderful. Just checking if you can see my screen now.
Yes, we see it.
Okay, excellent. Am I ready to go?
Yes, you are.
Excellent. Thank you so much, Irina. And thank you all for coming and attending, and especially for accepting that I will give this presentation in English. I think I followed most of what Irina said, but unfortunately my German is not quite yet to the level to present this in German. I have been known to speak quickly, so I will try my best to speak a little more slowly on this to make sure that everything I say is clear, because I'm really covering three really big points on what I believe are the big trends to watch in 2025, and just as importantly, a point how to actually take action and trade them using futures contracts. I'm going to be sharing strategies that I implement myself, what I believe are some best practices here. So as Irina mentioned, she will be the one seeing the questions, and we'll be getting to any questions you may have at the end. So please do ask questions in that question section on your GoToWebinar panel. Before I continue, I need to show one important disclaimer about me and my firm. And since this is my first webinar here on Finanzen, I thought I should introduce myself a little bit about me. Who am I and why am I here talking about markets and futures trading strategies? My name is Tarek Dennison. I am a professional investment advisor, trader, portfolio manager for private clients. I have been in this business now for over 20 years. And I've been running two of my own licensed firms, GFM Asset Management LLC in the United States and GFM Group Limited in Hong Kong. I moved to Switzerland a little over 3 years ago, so I am now based in Switzerland, and I do all of my Swiss and European business as part of a larger group company that I am not speaking on behalf of at this time, but you can look up and you can find information about that if you'd like to talk to me about what I'm doing specifically in Europe. Both under the Swiss and MiFID licenses. In terms of my background, I've been in the futures, options, stock and bond market since 1998. So I guess that's 26 years now, or it'll be 27 years, I guess, going on it. And I've worked at a variety of firms. I've worked at Bear Stearns in New York. I've worked at JP Morgan when that took over Bear Stearns. I worked at CIBC in Toronto and then London, and then I moved out to Hong Kong with CIBC. And then I spent some time at Societe Generale in Hong Kong before starting my own firm in Hong Kong as well. I've also taught fixed income and alternative assets at a university in Singapore for 7 years, finishing just last year. Yes, flying back and forth. And my office in Switzerland is now in Zug. So if you're ever in the Zug Old Town and you want to stop by and say hello to me, I would love to meet you. And I've really done a full tour of asset classes. So I have experience with cash equities, stocks, bonds, ETFs, swaps, futures, options, you name it. I am the finance nerd's finance nerds. The first market I ever got involved in was the currency markets when I was 6 years old. And I saw the Deutschmark go from 3.2 marks to the dollar to 2.5 marks to the dollar. And I was 6 years old at the time. If you remember when that happened, you now know exactly how old I am. A little bit more, if you want to read more about me, I've written 2 books, which I've shown at the panels at the bottom. One is Invest Outside the Box, Understanding Different Asset Classes and Strategies. That's basically a guide to different markets. There's one chapter on stocks, one chapter on bonds, one chapter on currencies, one chapter on crypto that really is kind of an introduction to investing. And my most recent book that just came out last year is 10 Ways to Invest. That's actually about 10 different investment philosophies. So that one compares value investing versus trend following versus dividend investing, and the philosophical roots underlying each individual strategy. If you Google my name, you'll also find that I've written over 200 articles, and I'm a frequent guest on CNBC Asia and radio television Hong Kong. So enough about me. Let's talk about trends and future strategies. So what I'm going to talk about today are really, like I said, the three main markets that I think are of greatest interest in 2025. One is the equity markets, and more specifically, I'm going to talk about US equities because these are now more than 2/3 of the global equity market, and they really explain ups and downs in stock markets almost everywhere. Here, there are 2 real indexes we're going to focus on, the S&P 500 and the Nasdaq 100. Then can't talk about the US without also talking about the Federal Reserve and interest rates. So I'm going to talk a little bit about interest rates, and I'm going to try to keep it as interesting and relevant as possible. I like talking a lot about interest rates, and I find people can find that a little bit boring, but I will at least show you how to use the CME FedWatch tool. And next time you talk to anyone about whether the Fed is going to cut or not, you can sound a lot more intelligent. And of course, I can't start 2025 without talking about crypto. Specifically, I'm going to talk about Bitcoin and Ether. And again, I could talk for hours about either one of those, but I'm going to talk about the main trends here and how you might put on a future strategy for them. I'm not assuming that you have experience trading futures, so I will start with the beginning and talk about the real basics about posting margin and mark to market. So if you have futures experience, please be patient with me. I just want to make sure that anyone here, including those that are new to futures, know how to, can understand how to get started and how to implement the strategies I'm going to talk about here. And then finally, at the end, any questions you may have, please type them in the questions section of GoToWebinar. Irina will read them out to me, and I will answer them. So, part 1, US equity indices, the S&P 500 and Nasdaq 100. If you ever turn on a financial news channel or go to, Finanzen, you go to any page on financial information, chances are you will see the S&P 500 on there. What is the S&P 500? It is basically an index, a measure of the average price of 506 stocks, and that's actually 500 companies, but 6 of those companies have dual share classes. For example, Google, Alphabet has both Class A and Class C shares, which are both in the S&P 500 index. And these 500 companies are pretty much the largest, most liquid, and most influential companies, not just in the US, but in the world. The S&P 500 alone is over 50% of global market cap. And you can just add the other slice of the US market to get the other 16% to see how the US is now 2/3 of all the stock market value in the world. One other thing to keep in mind, the S&P 500 has a quality filter. So generally, a company needs to be profitable for at least 4 straight quarters before the S&P committee will even include it in the S&P 500. But do note, the S&P 500 is not the largest 500 companies, regardless of that. It's the 500 companies that pass the profitability filter and are selected by the S&P committee. So once they're in there, then pretty much every index fund manager in the world, every trader has to own those companies, and that's what makes those companies so valued and so liquid. By contrast, the Nasdaq 100 index is simply defined by where the companies are listed. So the Nasdaq 100 is 100 of the largest non-financial companies listed on the Nasdaq board. So they're not New York Stock Exchange listed companies, they're Nasdaq listed companies, and specifically it excludes financials. And the reason for that is Nasdaq wanted to have a separate index for financials. It's often thought of as a technology index, and about 60% of the Nasdaq 100 is technology, but it also includes some non-technology companies like PepsiCo and Costco. So that's what you're getting very roughly when you're looking at the S&P 500 and Nasdaq 100. It probably won't surprise you that there's a lot of overlap between the two. If I were to ask you to name, say, 10 of the largest US companies, most of them are both in the Nasdaq 100 and the S&P 500. Now, generally, you're going to see a slightly higher weight in the Nasdaq 100 because any company that's in the Nasdaq 100, there's got to be more of them if it's spreading it among 100 names rather than 500 names. But that basically is what you see here. Apple, Nvidia, Microsoft, Amazon, Meta. These are, the largest and most famous companies, not just in the US, but in the world. That then asks the question of what is in the S&P 500 that's not in the Nasdaq. And not surprisingly, those top names, the ones that you see on the left, are the largest companies listed on the New York Stock Exchange. So the reason they're not in the Nasdaq 100 is because they're not listed on the Nasdaq, they're listed on the New York Stock Exchange. And these are still really good, really well-known companies, names like Berkshire Hathaway, JP Morgan, Eli Lilly, Visa. But some of the things you probably noticed is, first of all, it includes financials, which the Nasdaq 100 does not. And it also includes companies like Eli Lilly, which is a very valuable pharmaceutical companies making GLP-1s, companies that just happen to have chosen the New York Stock Exchange as their listing venue. So the S&P 500 is a little broader, a little more diversified than the Nasdaq 100, but both of them are very, very highly related, as I will show you. This chart is one that I would bet, if I asked you before I showed this chart, how many of you would have guessed if I said, how did the S&P 500 do last year? How did the Nasdaq 100 do last year? And you would have guessed they were within 2 percentage points of each other. Or perhaps better yet, if I were to change the color of these two charts and say, tell me which one is the Nasdaq, tell me which one is the S&P, how many of you would have actually been able to guess? So even though everyone said last year, it was all about NVIDIA, it was the Magnificent Seven again, it actually was a lot closer than a lot of people think. And I think this chart shows what it was like just over that 1 year. Now, if we zoom out over the past 25 years, we look at century to date, so basically going to 2000, the picture starts looking significantly different, and I think this tells a much more interesting story. So I really started, as I said earlier, I started in markets in 1998. So the first markets I ever saw were that big run up in the dot-com boom, the dot-com bubble of 1998, 1999, 2000. So we start this in 2000. What do we see right off the bat? The S&P 500 is down over 20% from 2000 to 2022. The Nasdaq is down over 50% over that period. So then you see over the next decade, the Nasdaq is just kind of clawing to catch up. It really only catches up by around 2018, 2019. So you're talking about over the past 25 years, the first 18 or 19 years, the Nasdaq was actually lagging the S&P 500. The main reason was that in 2000, when the century began, the Nasdaq was so expensive, was so overvalued that it came down a lot more in valuation than the S&P 500 could have. And since COVID, we've seen the Nasdaq just continuing to rise and rise and rise and rise. And these next charts I'm going to show you should give you an idea of how much of that was just expensive stocks getting even more expensive. So that is the big picture of the last 25 years that I want you to focus on. But of all charts here, spoiler alert, this one is by far my favorite chart. You'll notice the year 2000 is kind of right there, only a third of the way into the chart. But what this shows you is those bands around the red line are basically what is the implied price of the S&P, what should the level of the S&P 500 be if it were trading at 10 times earnings or 15 times earnings or 20 times earnings or 25 times earnings. That's what those bands are. So the fact that those bands are going up over time tells you that generally the earnings of US companies have been rising. So over long periods, that's what causes stocks to go up, is that compared with 40 years ago, earnings of US companies are 10 times higher than they were 40 years ago. So you'd expect stock prices to be roughly 10 times higher, but they're actually significantly higher than that. Why? In 1985, the S&P 500 was trading at less than 10 times forward earnings. It was very, very cheap. Stocks were still quite out of favor. In 1980, you saw the Business Week article, The Death of Equities. Then over the next 20 years, sorry, the next 15 years, you saw from 1985 to 2000, stocks went from less than 10 times earnings to 25 times forward earnings. They went from cheap to being close to their most expensive levels since 1929. Then that correction that I told you about from 2000 to 2002, and then again from 2007 to 2009 in the depth of the global financial crisis, you had pretty much a lost decade for US equities. But in 2009, 2010, stocks were again historically cheap. And I mean, the cheapest they had been since 1985. So clearly one of my big regrets was not getting even more aggressive in piling into to US equities in 2009, 2010. But I do pay attention to valuation, and I've been buying along the way. And clearly one thing I think now is I see the S&P 500 in that high end of the historical bands. I see it as very, very expensive. And that's why, for me, I'm not as bullish as many people are on the S&P 500 and large US equities generally. That said, this is just one chart. This is just one model. Stocks can get a lot more expensive. The market can remain irrational longer than any of us can remain solvent. So keep that in mind. Now, what I showed you was the valuation multiples of the entire S&P 500. It gets even more exaggerated when you look just at the what are called the mega cap 8. Now, sometimes you hear the Magnificent 7. I'm going to show you another acronym in the next chart. But this one is just showing the mega cap 8, which is Alphabet, Amazon, Apple, Meta / Facebook, Microsoft, Netflix, Nvidia, and Tesla. And for Alphabet, both share classes are included. And this chart shows you the price to sales ratio of that chart. In other words, for every dollar that one of these companies sells that actually generates in revenue, top line revenue, how much are you paying for a share of that stock? It went from, in 2013, roughly 2.5 times to now almost 8 times. So these companies, may be magnificent, but they are really, really, really expensive. Remember, this is not 8 times profit. This is 8 times sales. So you've got to multiply that by profit margin to really see what you're paying. And if we look back at 2024, that 24% return in the Nasdaq 100, 70% of that 24% return came from just these 6 companies. And this is the acronym I was mentioning to you. That acronym is Batman. So I didn't make this up. A lot of people have been talking about the new Magnificent 7 is Batman. Batman is Broadcom, Amazon, Tesla, Meta, Apple, and Nvidia. If you just kind of take these 6 companies and you put that acronym together. So that was most of the 2024 returns. And the question for 2025 is that trend going to continue? Is it going to still rocketing higher with these 6 leading it? Are we going to see a correction with these 6 leading the correction like we saw in 2022? Or other stocks going to start shining and these kind of going to languish in the middle? Those are 3 scenarios that we could paint for the indices in 2025. Now, let's talk about strategy. I could put the future strategy part at the end, but I want to kind of get really into it because chances are by now you may have some idea of one of 2 ways. You either think, okay, yes, Tarek is right. I think these indices, maybe are a little bit overweight. Maybe I'm a little too worried about concentration of a portfolio. Maybe I want to protect a little bit from the downside. Or heck, while it's going up, let's ride it. If it's going up, we buy it, and let's only sell it when we get out. The nice thing is with futures, you can do either one equally easy. So let's say, for example, you just wanted to add a little bit of US stock exposure. So unlike having to go out and buy stocks or buy an ETF or put money in a fund, all you need is a little bit of cash margin in your futures account. So I've just said here, let's say you have 10,000 in your futures margin account. You buy 1 micro E-mini S&P 500 contract. Now, every contract has a multiple. For the micro E-mini S&P, it's $5 per point. For the Nasdaq 100, it's $2 per point. So, slightly different values. So you buy 1 micro S&P at, let's say, 6,000. Now, that's the futures contract price. which can be a little different than the cash index level. But if you buy it there, you now have $30,000 worth of S&P 500 exposure with only $10,000 in your margin account. But that's fine, you've got that exposure. Then let's say two things happen. Day one, the price then goes from 6,000 up to 6,200. Well, congratulations, you were long. You were long a contract that went up, and then that next day's settlement takes that 200-point rise times $5 per point, meaning a $1,000 profit to you, and sweeps that $1,000 into your account. At the end of day one, you have $11,000 margin balance in your margin account. Very good. Now let's say the next day the reverse happens. The index goes down a lot on day two. It goes from 6,200 down to 5,800. That is a decline of 400 points. 400 points times $5 a point means $2,000 get swept out of your account. You are now left with $9,000 in your margin balance. So basically you get all the ups and downs of if you'd own the ETF or if you'd own the stock, except here you've got $30,000 worth of exposure with only $10,000 in your account, and that profit and loss gets swept in and out of your account on a daily basis. Before, any of you who are new to futures, I highly recommend that you master this slide and the next slide to make sure you understand what happens when you buy or sell a futures contract. This next slide shows what happens when you sell a futures contract. And as you saw, it's the exact mirror image, or it's the exact same thing as the previous slide with just the colors and the profit and loss different. So let's say that you think the index is going to go down. You think the index is overvalued, or maybe you've got a lot of US stocks or US ETF, and you want to hedge, you want to protect against it. So what you do is you sell one micro E-mini S&P contract. You sell at 6,000. Now you don't have to borrow it. You're not selling it. All you're doing is you click sell, and you've got a short position in your account. And you do this with, say, the same $10,000 in your futures margin account. Then, if the futures price goes from 6,000 up to 6,200, that's a 200-point rise. It went up when you are short. 200 points times $5 a point means $1,000 gets swept out of your account. So if you're short and the index goes up, you lose money. That $1,000 goes out of your account. You are left with $9,000 in your margin account. But then if you are still short at 6,200 and the price goes from 6,200 to 5,800, that is a 400-point gain for you because you're short and the index went down. 400 points times $5 per point is a $2,000 gain that gets swept into your account, leaving you with $11,000 margin balance. So for any of you who are experienced with futures, this is old news to you, good refresher. For any of you who are new to futures, please master these two slides before you trade futures. You will see how easy it is. Next, I want to show you one strategy which I think it's especially interesting when you're looking at futures, and this is a long-short strategy. So last year was kind of uninteresting for this because the S&P and the Nasdaq both pretty much moved in the same amount. But let's say, for example, you have a view that for whatever reason, the Nasdaq is going to outperform the S&P this year or over the next month. And that could be from any combination of things. It could be that the Nasdaq just goes up more than the S&P. It could be that the Nasdaq goes up and the S&P goes down, or it could be that they both go down. It's just that the S&P 500 goes down more. So what you can do here is if you buy one micro Nasdaq 100, and as mentioned, that is $2 per point. You buy that contract at 20,000, so you have 40,000 of exposure to the Nasdaq 100, and you sell one micro S&P 500 at 6,000. So you only are short 30,000 of the S&P 500. This is what your P&L table would look like. So what this shows you is that you'd only lose a lot of money if, let's say, the S&P 500 goes up a lot more than the Nasdaq 100. And you would only make a lot of money if the Nasdaq 100, either goes up a lot more than the S&P 500 or goes down a lot less than the S&P 500. So this table is just a very quick cheat or a very quick way of showing you how much would you make or lose depending on what the S&P and the Nasdaq do from this long short trade. But the ease of doing a long short trade like this is one reason I think futures are such easy instruments to use. So part two, let's talk a little bit about the Fed and rates. And this is my shortest section because I want to show you what I think is the most relevant, most interesting part without boring you. This part that I'm going to show you is called the CME Fed Watch tool, and I've included a link to it down at the bottom. And you'll notice up at the very top, I've clicked all the different Fed meeting dates. So you can click on, the 29th of January, 19th of March. I've gone ahead and clicked all the way to the end because I want to see what is the futures market telling us about where the Fed funds rate is going to be at the end of this year on the 10th of December, 2025. And here you see not only the full distribution right now in dark blue, but you also see what it was a day, 1 week ago and 1 month ago. And I did this snapshot last week, kind of, right around the, right before the Trump inauguration, right before the bond market kind of really hiccuped. So you can see what the change in expectation was from, okay, they're definitely going to cut a lot and we're likely to kind of have the rate below 4% by the end of the year, to suddenly that probability became a lot less likely. And right now, if you look at the current, you're pretty much seeing an expectation that the Fed funds rate is going to be right around 4%, more likely by the end of the year. Small chance it's a little bit higher, but no real expectation that it's going to be, below, say, 3.5 by the end of the year. So that's what you're seeing in the distribution here. Now, this is useful if you just want to know what the market is saying. What if you actually want to trade it? By the way, one surprise about this, as you may have heard, the Federal Reserve has been cutting interest rates, but they've been cutting short-term interest rates. And the big hiccup in the bond market has been on longer-term rates. This chart shows you the difference between 2-year and 10-year Treasury yields. Generally, you'd expect if you buy a longer-dated bond, you should earn a higher rate of interest. But for the past few years, pretty much since 2022, it's been the opposite. Short-term interest rates have been higher than long-term interest rates. And this has been the longest and deepest inversion of the yield curve since 1981. So this latest move where the Fed is cutting below 4% and longer-term bond yields are still around 4.5%, 4.8%, the curve is now finally normal again. And so that's really, I think, for me, the big news, and that's relevant, I think, to a lot of S&P companies as well. So let's say you want to trade it. What are two different ways that you could trade these two parts of the curve? Well, to trade the short end of the curve, you could just trade Fed funds futures, quite simply. So let's say, for example, you had a view on whether the Fed was going to cut or not in February or March or April. There are each of these contracts, and they all have very good liquidity. The size of them is an odd number. It's $4,167 per point. If you do the math on that, that's basically 1 month worth of interest on $5 million of cash at like a Federal Reserve deposit. So you're just really trading the interest on that $5 million. And the way to read the interest rate, it's 100 minus whatever this price is. So if you look at that March price of 95.705, you do 100 minus that, and that is 4.3% roughly. So that 4.3% is what the market is expecting the Fed funds rate to average in the month of March. If you think the Fed funds rate is going to be higher than that, then you would sell this contract. If you think the Fed funds rate is going to be lower than that, then you would buy this contract. That's really it. That's really, really, really quite that simple. And of course, you can get in and out of this just like you can with an S&P 500 future. If you want to trade the longer end of the curve, you can trade 10-year note or even 30-year note futures. And there is a relatively new micro size contract here. So the micro ultra 10-year note futures is $100 a point. So about $10,000 or $11,000 worth of bonds. Right here, you see that the March contract is trading at a bond price of around 111. So that's the implied price of a 6% note. So that's what, around about 4.8% yield if you do the math. If you think the 10-year yield is going to go up, you would sell this contract. If you think the 10-year yield is going to go down, you would buy this contract. So again, happy to do a lot more on bonds and interest rates, but for now, I'll leave it here and leave that to anyone who wants to talk more about rates. Now we get onto the part that's probably the trickiest, really depending on what you think of crypto, and that is Bitcoin and Ether markets, because these are also ones that you can trade with futures contracts. This is another chart which I'm not sure how many of you may have noticed, unless you've been paying attention for the entire year. For the first half of 2024, Bitcoin and Ether basically traded in lockstep. Basically when Bitcoin went up, Ether went up. When Bitcoin went down, Ether went down. Yep, there were a few gaps here and there, but they largely traded in lockstep. And that really changed in the second half of 2024. And there's a number of reasons that you might attribute to that. One of the bigger reasons I say is the rise in Bitcoin ETFs, which I'll show a little bit about later. Also, of course, it was the probability that the market assigned to Trump winning, and Trump seemed especially friendly to Bitcoin, of all cryptos. But generally, you could say last year has been an exciting year for crypto, and this is how it was reflected in the two largest cryptocurrencies, Bitcoin and Ether. When I was mentioning the rise of the Bitcoin ETFs, these are really the US listed ones. Of course, here in Europe, we've had Bitcoin ETCs and ETPs for a while. I think Canada's also had them for a while. But the rise in these is really nothing short of stellar. Of course, the leader by far was iShares, BlackRock iShares, followed by Fidelity. These are kind of your biggest legacy names who are really getting a lot of kind of traditional finance money into the crypto space, just basically buying billions and billions of it. And so if you line this up with the chart I was showing you earlier, that kind of feeds the narrative of how Bitcoin was the real beneficiary of these ETF flows. Now you'll also notice I included at the bottom the two large Ethereum trust ETFs, one from iShares and another one from Grayscale. And you'll see those are significantly smaller than the corresponding Bitcoin versions. For those who are simply looking to buy it and hold it in a vault, Bitcoin seems to be the currency. I'm largely using Ether to pay gas fees and transaction fees in DeFi, which is an entirely different conversation if you want to talk about staking and lending and liquidity pools and so on like that. If you purely want to trade the price of Bitcoin or Ether, you can use futures contracts and not worry about things like hardware wallets. Another factor which I don't think was, which I had a harder time reflecting in, that is the driver by one single company, and the company is MicroStrategy. So if you look at this chart of MicroStrategy stock price, it was basically kind of a struggling, not too special software company for really until about 2024, and then suddenly they announced that they were basically going to become a Bitcoin treasury company. So you wouldn't even go to MicroStrategy anymore for actual software. Basically what they were going to do is they were going to buy Bitcoin with their treasury reserves. Then they were going to issue debt and buy even more Bitcoin with the debt. And then as that went up, they could issue more debt because they had more assets on the balance sheet and buy more. So MicroStrategy has become a highly leveraged play on Bitcoin. And on top of that, you now have two ETFs that basically are leverage plays on MicroStrategy. So you have a leverage play on Bitcoin, a leverage play on a leveraged play on Bitcoin. And you know what happens to prices when leverage upon leverage upon leverage builds up on it. That can be really, really exciting depending on what your view is of where we are in the Bitcoin cycle and how that'll play. But I've shown you how to use futures to trade either a long or short position on it. Position carefully if you want to take a view. Very high level, I've kept this comparison slide towards the end with crypto because for the S&P 500 or for bonds, you'd say, okay, do I want to trade futures or do I want to trade an ETF or ETP? With crypto, you have a third option, which is to trade the crypto directly. So here I have a three-way comparison slide to say you can trade Bitcoin via an ETP, either by one of these US ETFs or a European ETF or ETP. You can buy Bitcoin directly, on an exchange or on certain DeFi protocols, although that's more with Ether, or you can use futures contracts. What are the advantages of each? Well, with crypto, with an ETP, you need to fully fund it or you need to get margin financing for whatever your position is. If you want, say, $10,000 worth. If you want to sell it short, you need to borrow the shares and short it just like you would short a stock. The ETPs generally don't pay you any interest. So if you've got Ether, you've got Bitcoin, that's what you got. You pay the fee and you don't you don't earn any interest on it. The ongoing fees inside the ETPs are generally quite high. They still are. Competition hasn't really brought them down yet. And the custody is centralized. So for me, that's one of the biggest problems with the crypto ETP is your whole point was that you're trying to get decentralized finance and you're trying to get things on a blockchain away from the traditional finance system. And these ETPs basically are the traditional finance system buying up a decentralized currency, putting it in a vault, and issuing a traditional finance instrument against it. So that's the crypto ETP route. If you were to buy crypto directly, you also have to fully fund it, or you can fund it using DeFi protocols. So for example, you could borrow USDC on Aave and then use it to buy more Ether or something like that, using your Ether as collateral. There are a lot of interesting ways of doing that, which are still developing. If you wanted to short a crypto on DeFi on chain, so let's say Ether, you could borrow Ether on a DeFi platform like Aave or Compound, and then you could sell it, and you would basically post the USDC as collateral. That's a lot like borrowing a stock, except you're doing it in a decentralized platform. Similarly, if you want to earn interest, you can do lending, you can do staking, you can do liquidity pools. There's lots of ways of earning yield on crypto in the DeFi ecosystem when it's outside of an ETP. The trading fees are often, but not always high. It really depends which network you're using, which exchange you're using, whether you're using a decentralized exchange. But that's one thing to keep in mind is the crypto ETPs will probably have lower trading fees, but higher custody fees. With direct crypto, you have lower custody fees, but you may have higher trading fees. Direct crypto, obviously, the biggest risk is losing your keys. Very often, you self-custody them. You use a hardware wallet, let's say maybe a Trezor or a Ledger. And you have to have a seed phrase, which you want to make sure that you back up and keep very, very safe. Not everybody is comfortable with that yet, so keep that in mind. By contrast, with futures, all you have to do is fund the initial margin. So if you want $10,000 worth of Ether or Bitcoin, you don't need to put $10,000 worth of cash right away. You get the leverage implied in the futures margin account. Also, it's just as easy to go long or short. If you want a short position, you can just click and you have a short position in, say, Bitcoin or Ether. And by the way, you can cross these two. So for example, one trade that I very often look at is, say, buy Bitcoin and sell Bitcoin futures, or buy Ether and sell Ether futures. Why? Because you can see what the implied yield is between the two of them. That's actually one other way of getting yield, by bridging these two in a way that you can't otherwise do. Whatever interest you might earn on Bitcoin or Ether is effectively priced into the futures contract. And we'll see that when we look at futures prices. And one big advantage of futures also is that the trading costs are generally very, very low. But you will only get the price exposure. You will not be doing staking. You will not be doing anything on chain. That's what you get when you trade Bitcoin or Ether via futures. Here are the tradable futures contracts, and you'll see here the Bitcoin futures, the difference between the next 2 months. So F and G are 2 subsequent months. You'll see that the following month is 103,000. When I took the snapshot, it was 103,680 versus 102,755 for the Bitcoin price. So subsequent months are traded at a significant premium to nearer months, basically implying an interest rate on that Bitcoin as you're holding it there. So that's what I mean by, if you want to play this interest, you can buy and hold physical Bitcoin and, say, sell Bitcoin futures at a later month to hedge your exposure to Bitcoin prices and earn the yield in the meantime. Now, on the Bitcoin, by the way, there's Bitcoin futures, micro Bitcoin futures, and Bitcoin Friday futures. A Bitcoin futures, if I remember right, is 1 whole Bitcoin. Micro Bitcoin is 1/10 of a Bitcoin, and the Bitcoin Friday is not only 1/50th of a Bitcoin, but they expire every Friday instead of every month. So your Friday futures, or if you want to trade this Friday versus next Friday versus next Friday, you would roll them a lot more frequency, but you can trade it in much smaller size. By contrast with Ether, you basically have full-size Ether and micro Ether. So 2 different size Ether contracts as well that you can trade your positions with. So I think I did okay on time. As mentioned, I'm just putting up here my name and where you can read a little bit more about me. I write a lot on Seeking Alpha. If you want to look me up on the Expat portfolio, I'm also on X, formerly known as Twitter, as Investing Expat, and YouTube as well. So at this time, I'll ask Irina if we have any questions.
Yeah, we have some. Received a few questions from our audience, what we should address. I will first read the questions aloud in German and then translate them into English for you. So, my first question is, ich bin nicht sehr risikobereit. Wäre ein ETF auf den S&P 500 sinnvoll oder sollte ich besser in den MSCI World investieren? In English, I'm not very risk tolerant. Would an S&P 500 ETF be a good choice or should I rather invest in my MSCI World?
So to be clear, this webinar is for educational purposes only, and I'm not giving investment recommendations. But what I will say here is the MSCI world is a little bit more diversified than the S&P 500. As mentioned, the S&P 500 is more than half of MSCI world. So the ups and downs of the S&P 500 will largely drive MSCI world. But the MSCI world also has European stocks. It also has Japanese stocks, Australia, Canada, and so on like that. So it is a lot more diversified. So if you want that exposure from the rest of the world and not be so concentrated in the US, that's an advantage of MSCI World.
Thank you. The next question is very similar. First in German, then in English. Wie volatil ist ein Krypto-ETP im Vergleich zum herkömmlichen Index-ETF? How volatile is a crypto ETP compared to a traditional index ETF?
Well, if you buy index ETF, you mean a stock index ETF, much more volatile. And I hope these two charts that I showed earlier give you some idea. So here you see Bitcoin and Ether, up and down, 114% and 43% in a year with huge swings in the meantime. By comparison, this is just a little bit of a sampling about how a stock index has moved. You had 300% over 25 years, not over 1 year. So that should give you some idea of how much more volatile crypto is than equities.
Thank you so much. The next question in German first. Welche Auswirkungen erwarten Sie von Trumps Wirtschaftspolitik auf die globalen Märkte, vor allem auf Krypto? What impact do you expect Trump's economic policies to have on global markets?
And including, I think you said crypto at the end as well.
Yes.
I mean, I believe
especially on crypto, sorry.
No problem. I believe that, my own view is that markets tend to overreact kind of right away. So I think a lot of the market's expectation about what will happen to equity markets, interest rates, and crypto have largely already been priced in or perhaps even overly priced in. One of the things I said in 2016 when Trump got elected the first time is I think a lot of people tend to overestimate him. His supporters think he's going to get a lot more done than he'll be able to get done. His opponents are fear that he's going to get a lot more done than he'll be able to get done. Now, this time, he's got a much more organized team and cabinet and so on like that, but he still has the narrowest majority in the House. And there's a lot of challenges he's going to have to overcome between what he said and what the market expects and what I think he'll actually be able to get done. So in short, I don't expect a huge impact that has not already been priced in. We're likely to see some continuation or some reversal of existing trends. But the bigger thing I would like to see is I would like to see some, actual progress on, say, crypto development. I think the idea of a strategic Bitcoin reserve is ridiculous. If it does happen, I should probably eat a hat or two. but that's my view. The biggest impact by far that I don't think has been priced in is what we're going to see on interest rates, because there's two big scenarios really to play out here. One is that he will succeed in blowing deficits out so much that the US will start becoming more like Indonesia and Turkey in terms of inflation and deficits. Or it's really not, he is not able to go that far and it becomes more like Europe and interest rates come back down. I think the current US interest rate level where it's 2.5% real is unsustainably high. I don't think the US economy will be able to handle that for a few more years.
Thank you so much. Very interesting. So the next question, first in German again. Wie riskant ist es aktuell in Bitcoin oder Krypto-ETFs zu investieren? Vor allem, da wir jetzt gerade gesehen haben, dass Bitcoin über 100.000 gestiegen ist. Und wie würdest du die Entwicklung It was in English, so yeah. Now, how risky is it to invest now into Bitcoin or ETF cryptos, as we noticed raising Bitcoin beginning January 25th over 100,000? How would you judge development on cryptos in 2025? Is there a correction to be expected?
Short answer is I have no idea, but if you kind of want my gut feel, I think it's extremely risky. I have long felt that Bitcoin especially is very, very volatile and very, very speculative. The value of Bitcoin right now is over $2 trillion. So if you think Bitcoin is going to go higher, let's say if you think it's going to go to 200,000, you have to make a case for why it should be worth $4 trillion. I'm not saying that it won't happen or that it can't happen. That's just the case that you need to make. We've seen how many times Bitcoin has fallen by 70% in a very, very short period of time. So, anyone who thinks Bitcoin is a store of value, I think has a much different definition of store of value than I would ever give it. I think my big surprise when I was running this was the difference between Ether and Bitcoin. I am on a relative basis more bullish on Ether than I am on Bitcoin because there's a lot that can be done with the Ether ecosystem. So full disclosure, I hold very, very little Bitcoin. I hold more in Ether than I hold in Bitcoin, but that's largely because I use it. I use Ether, for example, to pay gas fees, to lend USDC on Aave or on Compound, or to put into liquidity pools and to try to earn yield that way. And the fact that Ethereum has this whole ecosystem, to me, tells me there's a lot more upside, not just in Ethereum, but I also am interested in Solana and other networks as well, rather than Bitcoin, which is really just scarcity as a service. That's my own view. So far, I'm just very, very glad I haven't shorted Bitcoin, and I don't consider buying Bitcoin to be an investment. I consider it to be a speculation. So size your risk accordingly, I would say.
Thank you so much. One last question. Wie können Privatanleger von Marktumkehrungen profitieren, ohne übermäßigen Risiko ausgesetzt zu sein? How can retail investors benefit from market reversals without being exposed to excessive risk?
That is a wonderful question. I think that's a very, very useful question. So there are a few different ways. This presentation was mostly focused on futures contracts, and I think that may be a somewhat tricky way for retail investors to protect against reversals, because the way to do it would be to at some point sell futures contracts, and then if the reversal happens, then you've made money, and then you have to know to buy back in when the reversal continues. Personally, I do that using trailing stops. So I may take one of these futures contracts like the S&P, put a trailing stop under it. If the S&P starts going down, then I'll automatically sell futures contract at the trailing stop, and they'll have a trailing stop to buy back in once the reversal comes back up. That's a strategy that I have tested and I practice, and I'm comfortable with the risks and the benefits of it. But it's not for everyone, because you have to regularly go in and check and know trailing stops work and know what the risks are. A simpler way, in my view, is to use options. So let's say, for example, you think equities are expensive and you're worried that 2022 is going to repeat. You can just go out to the options market and you can look at how much does a put option cost or a put spread cost if I want to buy, let's say, 5% or 10% worth of protection against my US stock position. Those options are very, very liquid. I think they're very clear to understand, but I've given a lot of webinars and realized not everybody understands how options work or how to trade them, which is why if you'd like to see an options webinar, please let Irina know, and we will have a topic for our next event.
Thank you so much. We're at the end of our webinar, and thank you so much for the presentation and the detailed answers in our Q&A session. I'll continue in German for a moment. Ich möchte Ihnen, liebe Zuschauer und Zuschauerinnen, noch den Hinweis geben, dass dieses Seminar aufgezeichnet wurde. Sie können es sich jederzeit also noch einmal anschauen. Der Link zur Aufzeichnung zu weiteren Informationen erhalten Sie im Anschluss an diese Veranstaltung per Mail. Ein Aufzeichnungsartikel wird morgen auf der Startseite von Finanzen.net erscheinen. Tarek, I'd like to ask you for some closing words for our seminar today. What would you like to leave our participants with as a final takeaway?
The main final takeaway is that I hope if you're new to futures, you get comfortable looking at them as an easy instrument to access many, many different markets in a very easy, liquid, and efficient way. And if you're an experienced futures trader, I hope this gives you a refreshed perspective on how to use futures across these three different markets and trends.
That was a nice closing. Thank you. At this point, I'd like to thank you again for your expertise and the time you've dedicated to us today. I wish you a great day and, of course, all the best. Und auch bei Ihnen, verehrte Zuschauerinnen und Zuschauer, bedanke ich mich recht herzlich für Ihre Teilnahme an diesem Webinar. Ich freue mich darauf, Sie in einem unserer nächsten Webinare wieder begrüßen zu dürfen. Danke für die gemeinsame Zeit und weiterhin viel Erfolg. Bye, Tarek.
Bye, Rina. Thanks, everyone.